It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. Or you can listen at the Your Personal Bank app. Now, recently, the federal government shut down. And some people are kind of worked up about it, and others are shrugging their shoulders, saying, so what? Did you know that the longest government shutdown was only 35 days, and that was back in 2018? In fact, it had so little impact, few of us even remember. That gives you an idea of truly how little our federal government really impacts most people's lives. When the government shuts down, approximately 75% of all government employees continue to go to work. That's because they're considered essential or required for national security, or their funding for their salaries doesn't come from the annual budgets. It's only about 25% are at home, and every previous occasion, they got paid back pay for the time they were off, so they ended up getting a paid vacation. Now, first thing I say is, they're home because they're considered non-essential employees. The federal government's in debt. Why does it have any non-essential employees? There's been some discussion about if this shutdown continues, that the budget office can terminate these employees permanently. I hope that is the case, because that could be a great savings of excess employees, non-essential, that are not needed. In other words, we could cut about 25% of the workforce because they're non-essential. They're not working, and it's not changing anyone's lives. No one even would notice. Yet it would save us a ton of money. In fact, Rush Limbaugh discussed this during the 2018 shutdown. As he stated, this is exactly what we've wanted. The de-emphasis of government, the shrinking of government. This illustrates the redundancy in the number of people and the policies. The idea that people can function, that their lives can go on even in the midst of a partial government shutdown, this is a good thing. I agree. I agree completely. Also, did you know there's something like 600 government agencies? Why do they need so many? Many of them are just redundant and not necessary. So I'm hopeful that this shutdown results in some positive shrinking of the size of the federal workforce and shrinking of spending, which would be a great thing. Recently, the media made a big deal about over 100,000 federal workers resigning effective September 30th. And they were making a big deal that this was the Trump administration getting rid of all these people. But here's the reality. If you remember, federal employees were offered several voluntary buyouts. And the last one that was offered, the last date they could accept, was September 30th. So over 100,000 of the federal employees took a voluntary buyout. If I remember correctly, they're getting about 8 months severance. And the last day that they could still work and take that buyout happened to be September 30th. That's the reason why they left. It was all voluntary. But again, I'm in favor of it because overall it saves the taxpayers money, and many of these employees are unnecessary. Not even by my definition. They're non-essential according to the federal government. Another reason I'm glad to see the shutdown and hopefully some future reduction in spending is, did you know that the federal spending is now approximately 54% higher than it was pre-COVID? Yet our total population has increased about 2% in that same time frame. Now I ask you a simple question. Why does a government need to spend 50% more money when there's only 2% more people? It doesn't make any logical sense. Now, obviously, there's fraud, there's waste, there's redundancy. These are all things we don't need. It's creating additional debt, creating additional inflation, which is increasing the prices on everyone. It's hurting millions of people who are struggling just to get by, to pay for groceries and housing and the other necessities of life, just because we have some Congress people that refuse to cut spending because they benefit somehow in most cases. It's unfair, it's immoral, it's wrong. So anything that's going to cut the government spending, frankly, I'm in favor of big time, because the last question I'll ask, did we have what we needed pre-COVID? Were there roads? Did we have a military? Yes. The government functioned just fine on 50% less money than they are today. They could do it again. In fact, I would propose to you the government could spend 50% less than it does today, and no one would hardly notice. In fact, the only people that would notice would be the fraudsters and the ones taking advantage of the system, the grifters and the fraudsters. And you know what? I have no problem with that. They have no right to that money. They have no right to our taxpayer dollars. They're grifters. grifters, they're fraudsters, they're criminals. And another example of why the federal government has been spending so much, did you know, according to Social Security, the average Social Security recipient gets $1,200 a month, and that's typically after working 40 or more years. The average illegal immigrant receives $38.74 a month, and that's effective day one, and they came over here illegally. They're a criminal. They have no right to the money. This is something that should infuriate everyone, and it does. There's no reason why our federal government needs to keep spending that kind of money, particularly on fraud, waste, and illegals. Now, the other big news that's going on right now is the continuing AI euphoria, the hype, the bubble, whatever you want to call it. And interestingly, I'm seeing more and more articles discussing about how AI bubble talk is bubbling up again on Wall Street. And there's several reasons why this is occurring, and a lot of it has to do with OpenAI and this Oracle deal that's occurred recently. Now, the argument in favor of the fact that this is not a bubble is where you see people discussing this is sudden acceleration, it's not a bubble. And they're making the argument that AI is increasing in effectiveness and efficiency, and it'll continue to do so. So we're just seeing an acceleration. Yet, at the same time, we're seeing articles from MIT studies and others pointing out that very few companies, like upwards of 95%, at least so far, are not seeing any benefit financially whatsoever. We're also seeing other studies and articles talking about AI slop. In other words, employees are having to spend more time cleaning up the mess or the sloppiness of AI where they're assisting them in creating a report, for example. You read through it and it's a lot of words, but a lot of gobbledygook that doesn't make a whole lot of sense logically. So they got to spend time to go back and clean it up to make logical sense. This is actually causing a decrease in efficiency, not an increase in many cases. The other argument I see for the positive in terms of this not being a bubble is that the companies that are investing in all this AI infrastructure are profitable companies. So in other words, they can afford it. Now, part of that discussion even says in this long-winded article basically stating, hey, these are companies that are profitable, they make a bunch of money, they can afford all this infrastructure. They even say in the article they're spending money like drunken sailors. Well, isn't drunken sailor by definition a bubble-like statement? That would be my argument. A lot of investors are starting to have concern over, as am I. And that is this next wave of AI boom is now being fueled by debt. And if we look at this recent deal with Oracle and OpenAI, it turns out that Oracle stock jumped 25% recently after being promised $60 billion a year from OpenAI, which happens to be an amount of money OpenAI doesn't earn yet. And this is to provide cloud computing facilities that Oracle hasn't built yet. This will require 4.5 gigawatts of power, which is the equivalent of over 2 Hoover dams or 4 nuclear plants, which haven't been built yet. This increased level of borrowing will, of course, increase costs and reduce profitability. In fact, Oracle's debt to equity ratio is now about 500%, or in other words, they owe 5 times what they're worth. Now, that's not a good financial position to be in, especially if anything goes wrong, or if anything gets delayed, or if there's any challenges. Like I said, they're making promises that don't exist. OpenAI can't give them $60 billion a year. They don't have that kind of money. And Oracle can't provide the cloud computing facilities for that because they haven't built the data centers and they don't have the electricity to power them yet. They don't have the infrastructure to provide the electricity to power them. And you don't build nuclear power plants or large dams overnight. Those are things that typically take years, if not even a decade or more, start to finish. You've got all the permitting, you've got the construction. Even if they fast track it, you're talking about years. Yet investors, being euphoric, in my opinion, increase the stock price by 25% because of a promise that logically just is not going to occur for a number of years. Look, I'm not saying AI is not going to be a game changer or even fundamentally change our economy. I believe it will. It has the potential to, certainly, and I believe at some point it will. But just like we saw in the dot-com era, this is my 26th year in this business, in the financial world. I've been on this rodeo. I've seen this before, and I guess why I'm so skeptical is probably the best word I would use. I'm not negative, but I am skeptical. And it's because I've heard all this before. And no offense, but most people in the financial industry haven't been around that long. They don't remember the dot-com run-up. I do. I was there. We heard many of the same promises, the hype, all the excitement, the euphoria, literally. Ben Bernanke, the Federal Reserve Chair at that time, was famous for calling it irrational exuberance. I think we have some of that irrational exuberance going on right now. now, and I'm not the only one that thinks that. My point is simple. Regardless of how you measure the current valuations in the stock market, they are the highest levels ever recorded. This is going back to the 1840s. We are at levels higher than 1929 and 1999. In fact, we're in uncharted territory. This particular bubble is now outpacing every previous bubble in stock market history. When I make those statements, some people are surprised. It's part of that exuberance, as I was saying earlier. It's an emotional thing. You've been making money for so long, it gets to be the new comfort zone. You start feeling like you're bulletproof. The most difficult thing to do, any successful investor will tell you, is to separate the emotions from the logic. That's the hard part. And logically, when you're at all-time highs, historical highs never seen before in the history of the stock market, that's a time where you would want to reduce your risk. You'd want to pull some of the winnings off the table because the risk is elevated to levels never seen before, in fact. But that's a tough emotional thing to do. But if you want to keep those winnings, you need to pull some of them off the table and protect yourself from the downside. And here's the best part. Your personal bank policies and annuities can still provide you unlimited upside potential, but they also provide principal guarantee. Therefore, you cannot lose. You can lock in your gains. You can continue to enjoy the upside without risking the downside. And that's the prudent, logical financial decision to make. If you want more information on that, contact me at yourpersonalbank.com. I got some more things about the markets and the economy you're not going to want to miss, so stay tuned.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ferenc, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com. I'm Ferenc Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. You can also go to the Your Personal Bank app. Now, this recent study by Deutsche Bank was quite interesting. It stated that the AI bubble is the only thing keeping the U.S. economy together. And they go on to state that when the bubble bursts, now I think that's interesting, the statement they made there, when the bubble bursts. They didn't say if, they said when. And why do I think that's so powerful? I'll get back to it, but I think this is important point here. You've heard me state in previous shows that when the nights start getting cooler and the leaves start changing colors, we know it's fall. Winter is coming. We know it's going to freeze. What we don't know is what night is the first freeze going to occur. But we know it's going to freeze, and it's coming. There's no question we're in the late stage of a bull market rally. Will this continue for another week, month, or year even? No one knows. But we are in that season. The correction is coming. It's just a matter of time. And Deutsche Bank echoes that same statement when it says when the bubble bursts. You know, we hear this all the time. Oh, this time will be different. We heard that every other time. We heard that when the 08-09 crash occurred, the Great Recession hit. We heard that in the dot-com run-up. We've heard that every time previous, but each time it came back. The rubber band snapped back. It stretched too far, it reverts back to mean. That's what always happens. But let's get back to this Deutsche Bank study, because I think this is very, very valuable. Deutsche Bank states, when the bubble bursts, reality will hit far harder than anyone expects. That's so true. As I stated in the last segment, it's such an emotional decision. It's tough. The euphoria, the excitement, it's even a drug. It's kind of a drug even. That's the excitement of winning. But then when the losses hit, their first is like disbelief, right? These are all emotions that people go through. Separating the emotions from the logic is tough when it comes to money and investing. But to be successful, you have to do it. You have to make logical decisions. Otherwise, you eventually get burned. The point that's being made by the Deutsche Bank study is that some analysts expect the AI bubble to burst sooner rather than later, and their argument is that the current investment growth cannot continue indefinitely. They also state that the U.S. would be in a recession this year if big tech were not spending so heavily on building new AI data centers. The infrastructure building is literally saving the U.S. economy right now, but this kind of growth cannot be sustained unless spending remains on an ever-growing course. See, they're already spending at all-time records. As I stated earlier, some of the companies are starting to take on some debt. That's quite concerning, frankly. In the first segment I shared where Oracle is now at 500% debt-to-equity ratio. They owe 5 times more than they're worth. That's not a healthy financial position to be in. And Apple and IBM are actually at 200%. They owe twice what they're worth. Those are not good numbers, no matter how you cut it. And as this Deutsche Bank study continues to say, is the bad news is that in order for the tech cycle to continue contributing to GDP growth, capital investment needs to remain parabolic, and this is nearly impossible. They go on and even state that much of this growth comes from new facilities being built by humans for the most part, while the AI technology and services sector has yet to make any kind of meaningful contribution to GDP. Analysts in Bain & Company even go on and state that AI is likely to generate insufficient revenue to fund further growth initiatives. Too much has been spent. They state that by 2030, the anticipated demand for AI services would require $2 trillion in annual revenues just to meet the amount of money that's been spent to justify the infrastructure. Even the CEO of OpenAI, Sam Altman, has acknowledged recently that AI investors are behaving irrationally, and some will inevitably lose significant sums of money as a result. The question was asked, will AI capital expenditure continue to surge with staggering figures and impossibly high revenue expectations? One of the analysts stated that he predicted that 99% of so-called AI companies would not survive the bubble, while legitimate businesses are now squandering money and potential productivity gains in an attempt to turn everything into AI. That is a powerful, scathing study that Deutsche Bank has put out. Now, will all this come true? I don't know. No one does. But even if they're half right, this could cause some catastrophic corrections in the valuations of many stocks in the market right now. Another article points out this AI bubble makes past hype cycles look tame in comparisons. They go on to point out that AI deals have come to dominate the entire venture capital market at an unprecedented clip, dwarfing the quick concentration of investments during prior hype cycles, such as crypto or the mobility tech. They go on to state that the current valuations of these AI companies are mind-boggling, and how are late-stage investors going to exit their investments with their skin intact? It's going to be very difficult with the high valuations where they're at now for someone to get in and expect any kind of profit. That's the point of this whole article. Once people come to realize this, and enough do, that is oftentimes when the trigger occurs, when that downturn, that correction begins. They point out how many pre-IPO investors made enormous gains, but how most investors so far in many of these publicly traded companies are now already deeply in the red, and their prediction is it's going to become quite a bit worse. They finish off by saying the sky is not the limit. I thought that was quite interesting, but in the overall market, the S&P 500 now statistically is expensive on 19 of 20 metrics. These are all metrics from price earnings ratios, market cap to GDP. Regardless of how you want to measure it, not only is it expensive, in most cases, well, nearly all, it's at the highest levels ever recorded. And these are measurements, many of them that are going back all the way to 1900, so the last 625 years. We're seeing the highest levels ever. And the point they make on this article, I thought, in the chart showing all the different data points being at all-time high levels, is the four most dangerous words in investing are, this time it's different. And another shocking stat of the day is the top 10% of U.S. stocks now reflect a record 78% of total market cap for the U.S. stock market. This exceeds the previous record set in 1929. It's also above the peak of the 1999 dot-com bubble. The market has never, ever seen such concentration, and concentration involves higher or elevated levels of risk. And I don't have to tell you, I've shared this with many people recently, when you're looking at valuations that exceed 1929 and 1999, we all know what happened after, and it wasn't pretty. After 1999, the NASDAQ dropped 72%. Many people forget that. It was devastating. And here's another point that I don't think most people realize. The S&P 500 forward PE is now at the same level as it was in 2021, except the federal funds rate at that time was close to zero, and now it's over 4%. When you put that in consideration, it means a market is more overvalued today than it was even in 2021 based on forward PE. Investors are counting on AI to grow corporate earnings at an unprecedented rate, levels that have never been seen in history. As they point out in this article, it is now time to be more fearful than greedy. That was a famous statement by Warren Buffett. He was famous for stating, be fearful when others are greedy and greedy when others are fearful. We're seeing all-time levels of greed. That's why you should be fearful. I think Warren Buffett is right. Again, I don't know when exactly, no one does, but we are in the late stages. All indicators point to that, of being in the late stages of a bull market rally. And I saw this last chart I want to share in this segment that really gave me goosebumps, frankly. And they showed the NASDAQ chart from 1998 to 2001. So it was the last 2 years of the dot-com bubble and the first year of the correction. And then they superimposed the current NASDAQ 2023 to now. And it's amazing how closely it echoes. Again, history doesn't repeat itself, but it often rhymes. The last 2 years, from 2023 to now, has been almost identical to what the NASDAQ was from 1999 to just before 2000. If the NASDAQ continues the same pattern that it has for the past 2 years and rhymes what it did in 1998 to 2001, this shows that this current bubble has a few more months to run, and then you're going to start to see the correction. The top to bottom correction, again, was 72%. It was a 72% drop. That was catastrophic. I was there. This is my 26th year in the financial world. I saw it firsthand. I saw it with clients. Now, here's the beauty. I specialize in safe money, guaranteed, insured, tax-free, highly liquid. We have products that will give you unlimited upside potential, annuities, your personal bank policies, with no downside risk. They guarantee the principal. I've been doing this for 26 years. I did it then. I would meet with clients where they knew everybody they knew had lost a bunch of money, yet they hadn't lost a dime. They were more than thankful they had met with me. We had discussed how to reduce their market risk, yet still maintain strong upside gains. If you want information on how to do that, to reduce your market risk, prevent the correction from impacting you negatively, contact me at yourpersonalbank.com. Stay tuned in the next segment. I got a couple more things to share about this that I think are going to be quite eye-opening for folks. So stay tuned.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ferenc, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com. This is Ferenc, host of the Your Personal Bank Show. Great news! Most insurance companies have announced higher dividends for 2025. They also reduced fees. This will increase cash growth even more than before. This is the best time in over 40 years to consider a high cash value dividend paying policy. Also, dividends are expected to increase for the next several years. Contact me at Your Personal Bank or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. You can also go to the Your Personal Bank app, listen to any of the previously recorded shows, or contact me if you have additional questions or would like to discuss your situation further. So in the last couple segments, I've been discussing how the current market conditions, valuations are the highest levels ever recorded, including 1929 and 1999. I can't stress that enough. We all know what happened after those time frames. It wasn't pretty. It wasn't fun. Will this occur again? Well, they say it'll be different this time, but they said that every other time previous, and it always came back. It always reverted back to mean. And if it does repeat itself like the dot-com bubble did, the NASDAQ dropped 72% top to bottom, just so you know. Into the last segment, I shared looking at the NASDAQ chart, superimposing the last 2 years of the NASDAQ from 1998 to 2001, how closely they mirror each other is breathtaking. It's amazing. They almost are identical. If the current NASDAQ market cycle continues for the next year or so, like it did from 1998 to 2001, we have a few months left, folks, before this correction then turns over. And again, when it turned over, top to bottom was a 72% drop. I'm just saying, you might want to consider reducing your market risk or peeling some of the winnings off the table or something so that you don't get hit with those kinds of losses. If you've been winning, that's great. That's awesome. Be happy. Lock some of those gains in because they're not for real until you cash them in. You can have chips pile up on the table in Vegas, but guess what? Until you cash them in, it doesn't count, does it? Same thing with the market. It's paper wins or paper losses until you actually cash them in. Now, some people say, well, then I got to have to pay capital gains tax. Well, I'm going to tell you something. First of all, if you've held the position for a year or more, your capital gains is 15% for most people. Depending on your income, it could be zero. There's a lot of folks out there that if your income isn't that high, you could actually sell part of your position and pay no capital gains tax. A lot of people are unaware of that. If you want to find out more about that, contact me at yourpersonalbank.com. But here's the bottom line. Most people that are paying any kind of attention understand that we are in a market bubble, an AI hype bubble, and they're concerned about when it's going to burst. Well, here's the thing. It's not going to burst while it's being hyped to novices. You see, we keep hearing about what AI can do, but so far, at least, it just gives answers based on a consensus of message boards. It upscales cartoons to weird-looking quality, and it computes math problems like a calculator, and even AI agrees with that. Just ask ChatGPT if it's overhyped, and it will tell you that it's exaggerated claims of its current capacities and transformative economic impact. So even AI agrees that the hype of AI is overhyped. One of the last things I want to share about this, the argument for why this is not a bubble, is that the companies that are funding much of this build-out infrastructure and all that for AI are profitable companies. Now, I shared in the last segment where that is starting to change. Oracle has borrowed a ton of money. They're at 500% debt to equity ratio now. That's not good. Apple and IBM are like at 200%. Those are not good numbers. Some of the other companies still are in good financial shape. They haven't taken on a ton of debt yet, even though they're building out. Don't forget this. And a lot of people think that, well, the dot-com bubble was just a bunch of companies that blew up because it had no profits. Well, do you know that Cisco lost 80% of its value in 2000 despite having $20 billion in revenues? By the way, back then that was a big number. So they were a profitable company, yet they lost 80% of their stock value. Intel, Nokia, Yahoo were all profitable companies, yet their valuations, their stock valuations got crushed. So history shows valuation manias don't care about balance sheets. Sort of a rising tide raises all ships. Well, guess what? A lowering tide lowers all ships too. Now, here's the other issue I have about AI, and a lot of people are, and it has to do with the power requirements, the electricity. OpenAI has stated predicted that their new data centers will draw more power than the entire city of New York. And 10 gigawatts is what they're trying to build, is more than the peak power demand of the entire country of Switzerland or Portugal. Now, where is all this electricity going to come from? We don't have the infrastructure yet for that type of electrical power. That was one of the arguments against EV and the EV mandates. The power requirements to run all those cars and power them up, the electrical grid infrastructure didn't exist. The AI data centers have the same problem. And it turns out Bloomberg did an analysis recently of wholesale electricity prices for tens of thousands of locations across the country and revealed the effects of the AI boom on the power market. Now, it turns out that electricity costs wholesale are now over 267% more than it was 5 years ago for nearly every area located near a significant data center activity. Folks, this infrastructure boom of building these data centers are going to raise the electrical prices for just about everyone. And once people come to realize that, ain't going to be happy. And it's not going to be good for our economy. When you increase energy prices, that's bad for the economy overall, and inflation and all those types of things. I'm not saying insurmountable problems. They are problems that can be resolved, but these are things that are going to take time. You can't build out an electrical grid. You can't snap your fingers and build an electrical grid. You got to build power plants. You got to build nuclear facilities, dams, power lines. I mean, these are all things that take time to build infrastructure. That type of thing produces good jobs. It's good for what I call the real economy, or many economists, not just the AI data stuff. So there are some positives to all this. Don't get me wrong. Building infrastructure projects can be good for the economy, but it's also going to increase electricity costs until this infrastructure can be built out. This is why we're starting to see in what many call the real economy some real carnage. Fast food, home builders, home improvement, car sellers, lenders, payroll software, payment processors, private equity, all are really struggling in the economy or in the real economy. And the other issue I've never been a big fan of the Federal Reserve because it's not federal and it's not a reserve. It's a private bank that is owned by the private banks that influence public money policy. Not a fan. But it turns out the chairman of the Federal Reserve recently stated that the economy was growing at 1.6, yet the latest GDP growth numbers came out at 3.8%. So the guy that's in charge of our money supply was off by over 100%. I mean, he's so far off, it's ridiculous. And here's another concern statement that I found just mind-boggling from one of the federal governors, Michelle Bowman, in fact. And she said, I'm concerned that in the current environment, there'll be declines in house prices, and that could accelerate. Now, why should the Federal Reserve be worried about housing prices or asset prices, for that matter, at all? What is their mandate? Their mandate is supposedly to keep inflation in check. And their second mandate is to have a healthy job market. Now, frankly, that dual mandate is kind of silly because in most cases, they're contradictory mandates. You can have great inflation and bad jobs or vice versa. And oftentimes, if you say raise interest rates to curb inflation, that's bad for jobs. You know what I'm saying? They're kind of counterintuitive. They're counterproductive of each other. But that's their mandates. That's what they're supposed to be focused on. And they're talking about housing prices, worried that they're going to go down. Well, they're at all-time highs. They've been at all-time high levels. A lot of reason why they're inflated so high is because of all the printing and all the inflation and all the buybacks that the Federal Reserve was doing, keeping interest rates far below levels they should have been for far too long, which created an asset bubble. Them and the federal excess government spending were two of the primary reasons why housing prices shot up so high anyway. So it was their fault, largely, and now they're worried about it going back down. It was their foolishness, their stupidity, in my opinion, their lack of common sense that caused the problem, and now they're worried about it going down. Or you could translate it another way. The Federal Reserve is worried about homes becoming affordable for younger families. See, don't they count too? Why are they worried just about homeowners? What about people who want to become homeowners? When you have inflated housing prices, that causes many people to be unable to afford buying a home. Some of the latest numbers I've seen, only about 30% of the average Americans can purchase the average home in the U.S. because the costs have gone up so far. And here's another one I thought that was really eye-opening. This is from Fannie Mae. Their predictions, they state that mortgage rates rates will still be at 5.9% at the end of 2026. See, a lot of people think the Federal Reserve will be lowering rates, and then that'll mean mortgage rates are going to go down. Folks, I have some news for you that you need to know, and if you're not aware of this, you need to know this. Look, I can tell you what you want to hear, I can tell you what you need to hear, but mortgage rates have little or nothing to do with the Federal Reserve. Mortgage rates are based on the 10-year Treasury bond. You take the 10-year Treasury plus 2 to 3%, that gives you the 30-year mortgage rate. Now, the Federal Reserve has basically lost control of longer-term bond yields, and that's largely because the federal government keeps spending too much money, which means they're selling too many bonds, which is driving the interest on bonds up so they can get people to buy them. They have to entice the buyers by increasing the interest that are offering the government, which means the longer-term bonds, 10, 20, 30-year bond rates are going to stay high as long as the government keeps selling a whole ton of them. You know, we got $37 trillion in debt as it is, which keeps rolling over every year as it matures, so they got record levels of debt they're selling, and they're still continuing to spend more than receive, which means they're adding to the problem. They're adding fuel to the fire. It's becoming worse. Historically, if the Federal Reserve reduced interest rates, yes, interest rates across the board, bond yields and all that would tend to go down. But because of this new factor of massive levels of debt, my prediction, and I'm not the only one, most economists, most experts believe that the Federal Reserve dropping rates over the next, say, remainder of this year and into next year will affect shorter-term interest rates, which will be helpful for short-term borrowing, things like lines of credit and stuff like that, but it's going to do little or nothing for longer-term rates, like mortgages or car loans. And I can prove it. Recently, the Federal Reserve dropped interest rates a quarter point. What did long-term bond yields do? They went up. Why? The federal government was selling record amount of bonds. They had to entice the bond buyers to buy them because they got so many they're trying to sell. Basic supply and demand. So we're in a perfect storm, if you will, I believe. And again, why I keep saying this is the golden era of fixed assets, because annuity returns, your personal bank dividends, and things like that are based on long-term bond yields. And if you think about your personal bank policies where you want to earn more in dividends or interest or whatever, and then you borrow against it at line of credit, shorter term interest rates, well, if long-term bond yields stay up, that means dividends and all that will stay strong. Every prediction I've seen from every analyst you can name has predicted that bond yields are going to stay strong for the next 5, 10 years, if not longer, because of all the federal debt. So we're going to see increasing returns on the personal bank policies and annuities, probably the next 5, 10 years, if not longer, while our borrowing rates, when we want to borrow against it, access the funds tax-free, great positive arbitrage, still earn interest on money after we spend it, the borrowing rates for the shorter term stuff like lines of credit will be going down because of the Federal Reserve. This is the perfect storm. It's not necessarily good for the economy. Don't get me wrong. I'm not happy about all this stuff. But at the same time, these are things we can't change. We can rail against it. It's like you can scream at the sky because it's raining, but it's going to still rain on you, right? You can jump off a building and say gravity doesn't exist, but you're going to still go to the bottom and go splat. So you have to have some realism here and realize, okay, here's the situation I'm in. Long-term bond yields being high is not good for the stock market, typically, not good for real estate values. What is it good for? Fixed assets. What are those? Annuities, dividend-paying policies, stuff like that. Fixed assets. And if you can borrow against it from a lower rate, gosh, you could get 2-3% positive arbitrage. You can still earn that after you spend the money, which means you'll have more money available to spend in the next year and the year after that. You could use that to supplement retirement or anything else for that matter. If you want more information, contact me at yourpersonalbank.com. Be happy to share with you how this can enhance your financial future, how you can thrive through all of this economic, I guess you could say chaos, but whatever you want to call it, that we're dealing with. Stay tuned in the next segment. I got more things about real estate and a few other loose ends I want to touch on that I think you'll find very valuable, so don't miss it.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ferenc, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com. I'm Ferenc Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. And don't forget, you also can go to the Your Personal Bank app. Listen to any of the previously recorded shows you want to. Contact me if you have any questions, want to discuss your situation, whatever. Be happy to do so. So we have a situation where the Federal Reserve is worried about housing prices going down if we're in the current environment. And they were part of the reason why asset values went up so much because, well, they artificially kept interest rates well below where they should have been for far too long. So they were part of the problem. Fannie Mae's coming out saying that their projections that mortgage rates will still be at 5.9% at the end of 2026, and that's because they're projecting that long-term bond yields will continue to stay high for the foreseeable future. Most analysts say the next 5 to 10 years, actually. And remember, mortgages have really nothing to do with the Federal Reserve. They have to do with the 10-year bond yield. Take 10-year bond plus 2 to 3%, that gives you the 30-year fixed mortgage rate. So that's something most people don't realize, but important to understand. Fannie Mae's also recently coming out and stated that for housing to become affordable again, according to their calculations, the affordability back to 2019 levels would require prices to drop 38%, or incomes have to rise by 60%, or mortgage rates must drop by 4%. Now, which of these do you think would be the most likely to happen of those three? Prices dropping, incomes rising 60%, or mortgage rates coming down? Well, I've already shared where mortgage rates are based on the 10-year yield, the Treasury yield. And it's highly unlikely those rates are going to come down significantly anytime in the next 5 to 10 years. Even Fannie Mae themselves is projecting mortgage interest rates at 5.9 at the end of 2026. Again, because of all the federal debt. Even if the federal government stops spending more than it receives, still has $37 trillion on the debt on the books that they have to resell as it matures each year, much like CDs mature. Bonds mature each year, and they got to resell them at whatever the current interest rate is. Because there's so much of it, there's so much debt, they have to entice bond buyers by raising the interest they're willing to pay them or the bond yield, which pushes borrowing rates like mortgages up. So it's highly unlikely mortgage rates are going to drop by 4% from where they are now or anywhere close to that. Well, let's talk about incomes rising by 60%. Yes, I believe incomes will increase some. There's some reason to be optimistic about the economy, the real economy, that is. Infrastructure projects, all the investment that's coming into the United States, higher paying jobs, deporting some of the illegals, which does depress labor prices or employees' wages. So some of that going away will help. But to increase 60%, I mean, that's a big, big jump to get back to housing affordability. So I think we'll see a little bit of improvement in that area, but nowhere near 60%. So that brings us to the last option, according to Fannie Mae, and that's prices must drop by 38%. I think a 20% reduction in housing prices overall is far more likely or more. We've seen a record level of increase in pricing for housing over the last 4 or 5 years. That's no secret. There's been an effect of people being locked into their existing homes because they have these extremely low interest rate mortgages. So there'll be some offset as a result of that, or people reluctant to sell their existing home because their new mortgage interest rate would be double, which means their payment would be much higher. But here's the reality of life. Some people will stay, but others won't be able to. There'll be job changes, family changes, new kids, divorces, all types of life scenarios that are going to cause people to, well, they'll have to sell regardless of the price. And if they did buy it where they bought it for much less, and yes, it went up in value tremendously and they got a lot of equity, but if they have to cut the price by 10, 20, 30% or more even because they have to sell, yes, they will lose the paper value, but they're not really losing any actual money, are they? Just like a stock or a piece of real estate, you can have a paper increase or a paper value, but it doesn't really count until you actually sell the asset, right? That's that's when you lock it in. So due to life circumstances, there are going to be people, and that will increase over time, that will be forced to sell. And they're going to have to sell at whatever price the buyers are willing to buy. And when you look at the situation right now where the average American, only 30% of them can afford the average home, well, something's got to give. And like I said, of these three things, mortgage rates dropping, incomes rising significantly, or prices dropping, I think the path of least resistance for the most part is going to be prices dropping. We will see when and how long that occurs. Real estate market does tend to move far slower than the stock market. So this is something that we could see evolve over the next couple, 3 years even, let's say. But I think overall we're going to see a general reduction in prices, and we're already starting to see that in some markets, and that is increasing. Austin, most famously, has already dropped about 20% from its peak. Other places like Arizona are roughly 10%. Florida, Texas, we're seeing that in Seattle, Denver. We're seeing it in a lot of places. Just like there's been a concentration in the stock market, a handful of companies doing really well and the rest not so much. There's also a bifurcation with the real estate market in terms of areas. The Northeast and the Midwest are not seeing price drops if at all, where the West and the Southeast are. And a lot of it has to do with new builders building. Inventory has increased significantly in the Southeast and the West. Builders were able to build in many of those places because of less regulations and such, so they were able to build quicker. So the famous saying of real estate is location, location, location. Well, that's going to be very true in terms of valuations also. We're seeing already some reductions. I think we're going to see more of that. And others are probably going to hold more steady because, well, the inventory hasn't increased significantly, let's say over pre-COVID levels, like it has in other places like Florida and Texas and others. So it's going to be interesting to watch how this plays out. And you really need to look at what area you're in, what is the inventory, all those types of things. How many new builds are there? The new builders are really offering a lot of incentives and discounts, historical levels of those, so they can move inventory and continue to sell houses. Lennar, for example, the second largest home builder, has been famous for that. And they're approaching it as an effort to increase their market share. And so far, they're seeing some success in that. So those are the kind of things that can likely cause overall housing prices to ease, at least in certain markets or certain areas of the country. And the last part of this, I guess, is, another reason why I think we're going to see prices probably drop more likely than incomes increasing or interest rates dropping is that currently 2 in 5 of households, homeowners, and renters are now struggling to afford their regular rent or mortgage payments. This is according to a new Redfin study. That's nearly half of Americans are struggling to pay their mortgage or their rent, which means they're going to have to reduce their expenses. Let's say, 10 or 20% of those people would be a significant enough percentage to really cause an overall downward shift in the costs of mortgages or prices of homes or rent for that matter. There's a lot of pressure that way to the downside, and because of inflation, increased costs of everything, they've increased some, but not nearly as much. The study I shared, I think a week or two ago, was in the last 5 years, something like 80% of Americans, yes, their average income has increased, but so has the average cost of everything they buy, like food and clothing and housing and such, where they've basically been marking time. So they have not increased their buying power at all. And then debt, we've hit all-time record levels of credit card debt, for example. These are things that are really putting a downward pressure, pushing hard on a lot of people financially. It's getting tougher and tougher as time goes. And if we continue this 3% inflation rate, that stuff adds up. It's just going to make it more and more difficult, and more people are going to fall off the wagon, so to speak, economically. And it's going to cause a downward pressure. And as I stated in, I think, the first or second segment today, according to the Deutsche Bank study, they're stating the only reason our economy really is not in recession already is because of this historic level of spending on the AI infrastructure. And if that pulls back, there's nothing to stop it, right? And I guess that's why I want to kind of finish up with, I believe, this last article I saw, which I thought was quite interesting. It said the stock and bond strategy is so disliked, yet they're predicting it's probably your best investment move for the next 10 years. A lot of people out there have gone far heavier on equities, even if not intentional, by accident, if nothing else. Say you had a typical 60-40 split of stocks and bonds, and you didn't make any adjustments. The stocks have gone up, in the last few years so much that your percentage of your allocation is probably far heavier on the equity side now. And that has worked for the last few years, especially the last couple of years for a lot of people, especially in the tech area. But what MarketWatch is stating here is that's probably not what's going to work, at least through 2035. In fact, they're stating that a 60-40 split is likely to beat the S&P 500 through 2035. By the way, the 40% bonds could also be annuities, folks. Could be your personal bank. Doesn't have to be a bond. In fact, fact, your personal bank and annuities pay far higher than bonds, basically, because they add the profits of the insurance companies to the bond yields that the insurance companies buy because they have multiple income streams. So that's why we have annuities right now. They're, paying 7+% guaranteed first year, for example. I've got others with bonuses if you have a penalty in another product. Look, if you have an annuity that's over 2 years old, you really should look at the new ones. We've got companies that are paying 16, 17% bonuses even, and are providing more upside potential, even guaranteed, than what you've been earning in your older annuities. This is, again, because of the higher interest rate environment, higher bond yield environment than we saw 2-3 years ago. So it's so dramatically better. Again, golden era fixed assets, best time in over 40 years, definitely worth looking at. Like I said, this Market Watch article is pointing out a more conservative, say 60% equity, 40% safe. That could be bonds, that could be annuities, it could be your personal bank, and other advantages, tax benefits, liquidity, all those things with your personal bank or annuities. But they're just saying it'll probably outperform the S&P 500 if you say we're 100% there for the next, they're saying to 2035. There's a lot of reasons behind this. The higher interest rates, the higher bond yields are going to be overall a negative for the stock market returns, for real estate. Higher interest rates typically affect those kinds of things negatively. So the outlook is, hey, it's been great. What happened in the last several years has been, historic. And I guess let me finish with this because I think this is powerful. So I saw a study on this where it shared there were 7 times in the last 100 years that the S&P 500 went up 80% in a 3-year period. We have just experienced one of those time frames. What was interesting about what happened after that point. So after the 80% increase, 3-year run up, 4 of the times it occurred within less than 6 months, the correction occurred. And in 3 of the periods, it was over 6 months. The average drawdown, top to bottom, was 35%. But what also was interesting was the 4 times that the top peak occurred less than 6 months after the 80% run up over 3 years, the drop averaged about 25%. But the 3 times that it lasted longer than 6 months, the average drop was then 50%, which makes sense. If the hype continues, the bubble runs up higher, the correction's going to be even stronger. Kind of like that rubber band. The more you pull it, the more violently it's going to retract and return back to mean. I don't know when it's going to happen. No one does. But the market's going to correct. No one knows when. No one knows how long or how bad, but it's going to correct. Just like, as I shared earlier, when the leaves start changing colors and the nights start getting cooler, you know it's fall and you know winter's coming and you know it's going to freeze in most parts of the country. But you don't know what night is going to be the first freeze, but you know it's going to freeze. That's where we are. We're in the late stages of a bull market rally. It's going to correct, and because of the historic nature of this bull market, the largest ever seen in history going all the way back to the 1840s, the correction could be quite aggressive and quite violent because of the extreme nature of the run-up. Protect yourself. Reduce your risk. Take some of the winnings off the table. Continue to benefit from the upside. Annuities and your personal bank policies can do that. Unlimited upside potential with no downside risk. Contact me for more information at yourpersonalbank.com. Stay tuned next week to the Your Personal Bank Show for more great information, and as long as it's on our money, in God we trust.
When people contact me, they often ask, what exactly do you do? And yes, if you contact me, I, Ferenc, host of the Your Personal Bank Show, will respond, not an assistant. I help people increase their returns, reduce taxes, increase positive cash flow, and reduce market risk. I accomplish your goals using various financial tools, including your personal bank. If you have questions or would like to discuss your situation, contact Ferenc at 866-268-4422 or yourpersonalbank.com. This is Ferenc, host of the Your Personal Bank Show. Great news! Most insurance companies have announced higher dividends for 2025. They also reduced fees. This will increase cash growth even more than before. This is the best time in over 40 years to consider a high cash value dividend-paying policy. Also, dividends are expected to increase for the next several years. Contact me at Your Personal Bank or 866-268-4422. That's yourpersonalbank.com.
Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice.
This is Ferenc, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.